Hey, welcome to this episode of InvestU. Today we're going to be doing a deep dive into Prudential Financial. So a bit of information about this stock. The ticker is PRU. It's traded on the New York Stock Exchange. This analysis was performed on the 13th of April 2020 and presently has a market cap of $23.2 billion. The stock price is presently trading at $58.70 per share, and the number of shares outstanding are 396 million. So let's quickly go through our investing rules. This is especially important as we enter into a bear market and a lot of uncertainty, and we're really looking for stocks that have a lot of deep value. So we're looking for a PE ratio of less than 25, a market cap of greater than 500 million, which the stock has, a current ratio greater than 1.5, a return on equity of greater than 5%, a debt to equity of less than 50%, an earnings per share consistent growth, 10 years of consistent dividend payments, dividends typically greater than 2% as we are big dividend investors, good intrinsic value, so having an intrinsic value greater than our stock price. And at the end of the day, it's very important to keep in mind that we are not in this for the short term. We're not looking to have huge percentage gains month to month. We are in this for several years, if not 10 years. So we want to pick stocks that we can buy at a good value, forget about, and check on a quarterly or semi-annual basis to see how things are progressing. Okay, let's go through some key metrics for this stock. So as mentioned, it's presently trading at $58.70. It has a PE ratio of 9.16 and an earnings per share of 10.12, which would give us approximately a 17% return, though we understand that the earnings situation might be a little bit bleak because of the market conditions with coronavirus. The dividend yield right now is 7.27%. Price to book is 0.34, which gives us a margin of safety of 198%, which is really, really good. So what this is telling us is that the book value exceeds what the price is. And this is something that is really, really an attractive situation to be in. And I'll post a book note in the notes below that is a Benjamin Graham book on value investing that really highlights the need for some of these things when you're looking at stocks and selecting stocks through a stock picker and ultimately looking for good value and good safety. Because at the end of the day, we want to have unlimited upside but protect our downside. Debt to equity is 12.45. And a return on equity of 48%. Current ratio is 2.15 and an EV over EBITDA of 15.02, which is pretty good. Correlation to the S&P 500 is pretty strong at around 70%, and it does have a lower correlation to some telecommunication stocks and also to Walmart and some other big box shopping outlets. So in this slide, I just wanted to go through the Prudential Financial Dividend per share outlook. We can see that at around 2007, when we had some of the financial crash, we did have a peak for our dividends, and it did drop for the 2008 crash. But it has picked up since 2008, and we have had continuous growth ever since. So, we do meet the requirement for 10 years of dividend growth, though in these uncertain times for our markets right now, I would say there is risk for dividend drop. But, if we expect to see a small drop like we had in 2008, then we're still going to be probably around the 5% range, which is a decent dividend return. And we hope to see that climb over time. So from a value investing standpoint, if we can get in early at a good price and watch that dividend grow, we should exceed a 10% dividend in a few years. So let's look at the dividend coverage. So this is going back a few quarters, and we'll see that for the most part, we had good coverage with the exception of a couple of quarters, so Q4 in 2018 and Q4 in 2016. Overall, year over year, we had pretty good coverage for these dividends, and it's been consistently good earnings for this company. So from a long-term perspective, I'm not concerned that they're paying out too much in terms of dividends. Their earnings do support their payouts. So this printout for value over time is coming right from our stock screener that we have prepared, and a copy of this is available. All you need to do is email me, and I'll list my email in the show notes below. So what we see year over year is consistent revenue growth from 2010 up to 2019. Net income has seen some spikes, and I think the example for the earnings per share dip in 2018 can really speak to why we had that issue, and we'll do a bit of a deeper dive into the books to see why that might be. But with the exception of 2017, which appeared to be a fantastic year, we have seen fairly stable net income. The assets are growing on a year-over-year basis, as have the liabilities have been as well. But as we see too, if we go down to the shares outstanding, and that's in per millions of shares, we are seeing that they are consistently buying back shares. So there's less shares on the market, and perhaps that's what they're using some of that increased debt for. Overall, the total shareholders' equity is growing on a year-over-year basis. Debt to equity is showing a downwards trend, and the current ratio has been remaining fairly strong. Great earnings per share on an annual basis, and it definitely covers off their dividend payouts that we are seeing, with the exception of 2013 and 2012, but they still managed to pay out those dividends, which is a positive thing that they're focused on that as a overall company. Fantastic book value that we're seeing per share here. Right now it's 158.25 relative to a stock that's trading around 58. We have lots of coverage there. So also coming out of our stock screener here is we do a comparison to its competitors in the market. So what we want to look at is how is its dividend yield compared to its peers? Let's look at debt to equity ratios. Each industry is a little bit different in terms of what debt levels they carry based on the business that they're in. We'll look at price to book and PE ratios. So if we take a look at dividend yield, it is the strongest amongst its competitors. From an earnings per share perspective, it's also the strongest amongst its competitors. PE ratio, I'd say it's towards the lower end, though there are some other financial groups that have lower PE ratios. From a return on equity perspective, it's not the highest amongst its group, that's for certain. It's actually probably towards the lower end. But definitely a strong price to book. I'd say one of the top ones. There's a couple of other financial groups that are out there that are slightly better, and I'd say a debt to equity that is in line with probably the average of its peers here. So nothing that's really outstanding or alarming when I compare some of the key metrics of this stock to its competitor or its peers. So we're going to do an intrinsic value calculation for this stock. We use a growth rate of 2.69%, and that is based on net income. We are discounting that at 10% and using a growth rate in perpetuity of 2%. Using the 2019 free cash flow, we result in an intrinsic value of $327.83, which greatly exceeds the current stock price. So let's dig into the annual report and look at some positive and negatives. So they are the largest insurance company in the U.S. They have a focus on insurance, retirement income, and asset management. They presently have $1 trillion under their global asset management, and that's tied up in some fixed income equity, some real estate, alternative investments, and equities itself. So I'd say it's a good mix of things, so we're not too concerned that they're heavily invested in the equities market, which has taken a bit of a hit recently. So they do have other ways of making money and keeping their global asset management up in support of retirement income for individuals that are using this service. They have a fairly large pension plan program, which is referred to as U.S. Workspace Solutions. They have acquired Assurance IQ in 2019 for $2.35 billion, and that service delivers technology to consumers for company plans and allows companies to pick from a menu of items for their employees as they're going through their solutions in this area. They started a streamlining business initiative, which should save $500 million in expenses year over year. Prudential acknowledges that they're a large company and that they have some efficiencies to gain in their spending and in staff. So from a negative perspective, so low interest rates will impact their portfolio income yields. So as we get down closer to zero interest rates, that is going to have a big impact on Prudential. So one strategy could be to take on riskier investments to offset lower yields based on their portfolio mix. I would be surprised if they transferred a large volume of funds into the equity market, but they could be looking to do a play like that, very similar to what Berkshire would do, where they have a large volume of cash on hands and invested in the market where good opportunities present themselves. They recently sold Prudential Life Insurance of Korea for $1.9 billion. They mentioned that the cash is being used just for general corporate purposes. Hopefully this is not a sign of negative things to come, that they need the cash, and it is just something they're looking to do to better their books. Net assets of PGIM had a 1.9% loss as of February 2020. They have temporarily suspended their 30-year term life insurance application as a result of the coronavirus concerns, so that is a major evolution recently. They'll obviously see less money coming in for that for the short term, but they need to sort of recalibrate for how they're going to deal with some of these things and the rates for the long term. And I think the stock has taken a bit of a hit, as has other insurance stocks, because of concern for insurance payout during coronavirus. I think if you look at the overall mix of deaths in the United States on an annual basis, the increase in deaths due to coronavirus isn't too out of the realm of the total deaths per year. I know this is a morbid topic to speak about, but we're looking at potentially a 3.55% increase in the total population, based on some projections of 100,000 deaths for coronavirus, based on some of the statistics and projections we're seeing. So obviously that will have a hit on their bottom line if they're paying out for insurance as a result of this, but nothing that is too high. And they should be able to cover off these additional expenditures and still remain a healthy bottom line. So again, in summary, going back to the intrinsic value, we use a growth rate of 2.69%, discounted at 10%, growth rate in perpetuity of 2%. We arrive at an intrinsic value of $327.83. Thanks for tuning into this episode of InvestU. Please shoot us an email at valueinvestu@gmail.com, and we'll send you a free copy of our stock screener. And that also has comparisons in key metrics to its industry peers, as mentioned in this video. And don't forget to click subscribe below.